All right, recording is started. Again, guys, welcome to class one of the Sherpa system. Class one tonight is going to, like I said, cover the fundamentals. We'll go over some terminology. I'll show you how to count pips. I'll show you how to calculate how much a pip is for a certain currency pair and things of the sort like that, right? It will cover a lot of information, but for the most part, it's nothing that's going to be mind-boggling or anything like that, right? And it honestly should help you guys understand a hell of a lot more of what you're going to be doing. So let's get right into it. Like I said, guys, you're my guinea pigs. Like I said, I don't mean to use you all as guinea pigs, but hey, sometimes I have to have some feedback so that way I can critique it and build up from it, right? So welcome to the Sherpa system, guys, right? Of course, my company's War 3 Associates. My name is Corey Collier. I'm partnered with the Xchange group, the Exchange Trade Group. Excellent guys. We've got my partner, Brian, who's going to be my chat moderator, all right? So in this system, you've got a few different modules, right? We'll be covering introduction module, the psychology behind trading module, risk management, and risk and how to manage it, fundamental analysis, technical analysis, and then we'll get deep into the War 3 strategy, okay? Now, I know that may seem like it's a short thing, but those are just the titles of the modules. Each module has different sections, all right? So right now we're on the introduction module, all right? So before we get started, guys, if you guys do not have any type of Forex software set up or anything like that, again, this is some prerequisites that I actually recommend for you guys, okay? You can always use a broker of your choice. There's no set broker that we really recommend just yet or anything like that. I currently use Owanda, which is a Canada-based broker that's FTC regulated, and KOT Forex, which is a non-regulated broker. Use at your own risk, guys, okay? So you want to open up a practice account, and when you open up your practice account with your broker, guys, be sure to use an initial trade amount that's relative to what you realistically deposit with your live account. That's what's going to get you a better practice or demo account experience than just saying, hey, let's just make it with $10,000. If you can't trade with $10,000, guys, something's wrong with you, basically, okay? So start with something that you would realistically deposit in your first live account, all right? The trade software that I use, guys, I'm on a Mac, and I don't know if you guys know much about Macs, but trying to get MetaTrader 4 software on a MacBook is ridiculous. You have to downgrade your software and do all this other stuff. So I just stick to the MetaTrader 4 mobile for my trade execution, but I use tradingview.com for my chart markups. I do want to warn you guys, there is occasional disparities in some instances due to the difference of liquidity providers with your broker and the TradingView software, okay? So just keep that in mind. TradingView also has a mobile app, so that's why I like TradingView. Not only that, it's got a lot more charting tools and capabilities over the MetaTrader 4 software itself without having to install like EAs and things of the sort, right? The third thing that I require, guys, is a mindset, okay? Please allow yourself time to unlearn anything that you may have learned and patience to learn this system. This isn't a Holy Grail system, and I'm going to help you keep things in perspective as we get further in the course, okay? My system is a technical analysis system, all right? So what you learn from me, guys, you're going to be able to use with other people's system because I'm teaching you basically almost naked trading, okay, with a kind of like a little spin to it. I'm teaching you price action. So let's get right to it. Introduction, what is Forex, guys? All right. Start where you are, use what you have, do what you can. That's a nice quote by Arthur Ashe. What that quote means, guys, is wherever you are in your life right now, whatever walk you are, if you're down, guys, understand Rome was not built in one night. Don't expect to be a millionaire in one night, okay? So just start where you are, use what you have, and just do what you can for right now. You know, sit back and learn. So what is Forex? Within social media, I'm beginning to find that it's a misconception about Forex that it's a company itself or a pyramid scheme or a scam, okay? You're highly mistaken. Forex is a financial market, okay? Now there's companies out here that will teach you how to trade. And they offer, I guess, you know, like an MLM, they'll offer a recruitment side to it. That's perfectly fine and dandy, all right? But no, Forex is not a company. It's not something that you join. It's something that you do to produce something, okay? This is big boy shit right here. It's not nothing that you join, guys. So keep that in mind. It's an actively traded market. You trade it 5 days a week, 24 hours a day. It opens at 5 p.m. on Sundays and closes at 5 p.m. on Fridays, all right? So you can virtually, honestly, trade all day, every day within those hours, but we don't recommend that. We'll get into that later. People or entities that trade the Forex market, you've got the retail traders. We're the bottom feeders, you and I. Above us, you've got banks, then you've got governments, investors, businesses, hedge funds, things like that, all speculate and exchange currencies that are available via online brokers, okay? The Forex market to the retail trader is still relatively new, guys. It's younger than I am. I'm 33, it's about 24, 25, okay? So keep that in mind. We weren't able to trade in this market due to not having the proper leverage. So what I mean by that is back in the day, in order to even get into this market, you literally had to have liquid cash, all right? You had to take that to your bank or to a broker and tell them what you wanted to do with it, right? It wasn't like nowadays. Thanks to online brokers, they give us the leverage to be able to trade. And so thanks to the internet, which sprouted up in the early 90s? So if that gives you a perspective of how young the Forex market is to a retail trader, right? So we use a combination of fundamental and technical analysis to predict probabilities of a currency's next move, whether it be up or down, all right? So we can make money, guys, buying and selling. And again, you can't join this, bro. This isn't a company. This is a financial industry, right? Ain't nobody got time for that. All right, so here's how the whole process works. Like when you enter a trade, right? This is what happens, okay? So you've got the trader. We're over here, right at the top. You've got the trader using an electronic trading platform. That platform is your broker, whether it's TD Ameritrade, Owanda, or KOTFX, right? Depending on what type of broker you have is going to determine your trade experience, okay? So for instance, you never really want to try to trade or use a dealing desk broker. And the reason why is because dealing desk brokers take the opposite position of their clients, guys, okay? So they make money on your losing trades. So they want you to lose, right? But the trades that you do win, guess where they get them funds from? So I like to use either an ECN or a straight through process, which connects you directly to, banks, hedge funds, mutual funds. Those are the people and brokers. Those are the people who are going to be the other side of the trades that you enter, right? So that's what happens inside a single Forex transaction, right? And again, it's 100% fact, guys, that you do not need to join a company to learn how to trade Forex. They help you though, okay? So what is traded in Forex though? Shortest terms, it's currency, all right? It's currency, futures, some crops and commodities, but for the most part, we're focused on currency, right? Forex is just a general name for currency trading. It's important to point out that we are covering different ways that individual traders can trade Forex. So we're over in the spot market under the retail Forex, okay? There's still futures, there's still options, there's still ETFs, CFDs, and there's still spread bets, stuff like that, right? Those are just different ways to trade a currency. What I'm not gonna go over, guys, is like FX swaps and forwards, because those cater to institutional traders. And that's something that we can probably get into in a deeper study, but nothing like that tonight, all right? So what is a currency future? A currency future or a future is a hedge against future profit loss. So futures are contracts to buy or sell a certain asset at a specified price on a future date. That's why it's called futures. A currency future is a contract that details the price at which a currency could be bought or sold and sets a specific date for the exchange. Currency futures were created by the Chicago Mercantile Exchange, or the CME, way back in 1972 when bell bottoms and platform boots were still in style, right? Since future contracts are standardized and traded on centralized exchange, the market is very transparent and well regulated. This means that price and transaction information are readily available, okay? Here's 2 bullet points. The rate for currency future contracts is derived from spot rates of that currency pair. And if you don't know what that is just yet, we'll get deeper into that as I go on, okay? Currency futures are used to hedge the risk of receiving payments in a foreign currency. So here's the example that I've got to help you guys better understand that. So assume hypothetical company XYZ, which is based here in the United States, right, is heavily exposed to foreign exchange risk and wishes to hedge against its projected receipt of 125 million euros in September. So company XYZ is going to be receiving 125 million euros in September, a future date. Prior to September, the company could sell those future contracts on the euros that they will be receiving. So the Euro FX futures have a contract unit of 125 euros. They sell those Euro futures because they are a United States company and don't need euros. We need the United States dollar. Therefore, since they know that they will receive euros, they can sell them now, lock that in at a rate at which those euros can be exchanged for dollars. All right. Company XYZ sells 1,000 future contracts on the euro to hedge its projected receipt. Consequently, if the euro depreciates against the dollar, the company's projected receipt is protected. Are you guys following that? I'm gonna read that again. If the euro depreciates against the dollar, the company's projected receipt is protected because they locked in their rate, right? So they get to sell their euros at that locked in rate. However, the company forfeits any benefits that would occur if the euro appreciates. So it can go either way. So okay? They are still forced to sell the euros at the price of the future contracts, which means giving up the gain relative to the price in August that they would have had if had they not sold the contracts. So they took a loss. The other way to trade Forex is you've got currency options, or better known as kind of like a binary option. An option is a financial instrument that gives the buyer the right or the option, but not the obligation to buy or sell an asset at a specified price on the option's expiration date, okay? Binary options are typically, I would say scalp trades is how I learned how to do it. You know, I spent a lot of time on 1, 5, and 15-minute charts, never really anything over an hour. If a trader sold an option, then he or she would be obliged to either buy or sell an asset at a specified price at the expiration date. Just like futures, options are also traded on an exchange such as the CME or the ISE or the PHLX, all right, the Philadelphia Stock Exchange. However, the disadvantage in trading Forex options is that market hours are limited to certain options and the liquidity is not nearly as great as the futures or the spot market. All right, so that's one reason why I didn't really swing trade too much or anything like that with the Forex or binary options. All right, so the currency ETF. ETF is an exchange traded fund. A currency ETF offers exposure to a single currency or a basket of currencies. Currency ETFs allow ordinary individuals to gain exposure to the Forex market through a managed fund without the burdens of placing individual trades. ETFs can also be used to speculate on Forex, diversify a portfolio, or hedge against currency risk. They're created and managed by financial institutions that buy and hold currencies in a fund. So it's kind of like a pool of money. They then offer shares to the fund, to the public on an exchange, allowing you to buy and trade these shares just like stocks. Like currency options, the limitation on trading currency ETFs is that the market isn't open 24 hours. And also there's subject to trading commissions and other transaction costs. So we don't even focus on them, but it's good to know different ways to trade because not everybody works in the spot market. Now, this is kind of the realm we are in, but this is like a step above that, okay? The spot Forex market is an off-exchange market or an over-the-counter market, right? The off-exchange Forex market is a large, growing, and liquid financial market that operates 24 hours a day. It's not a market in the traditional sense because there's no central trading location or exchange for this. In an over-the-counter market, a customer trades directly with the counterparty, kind of like what we will be doing. But unlike currency futures, ETFs, and most currency options, which are traded through centralized markets, spot FX are over-the-counter contracts, or they're a private agreement between two parties. Most of the trading is conducted through electronic trading networks or by telephone, right? The primary market for the FX is the interdealer market, where Forex dealers trade with each other. So this is more like a dealer-to-dealer thing, okay? So for visualization, this would be like, we put our trade into our broker, right? That's a ECN or a straight-through broker, right? That broker then has to find another broker or a dealer that's going to take the other side of that trade. That's the spot FX market, okay? Let's see. A dealer is a financial intermediary that stands ready to buy or sell currencies at a time with his clients. The intradealer market is also known as the interbank market due to the dominance of banks as Forex dealers. The intradealer market is only accessible to institutions that trade large quantities and have a very high net worth. So that's going to be like banks, insurance companies, pension funds, large corporations, and other large financial institutions that manage risk associated with the fluctuations of the currency rates. In the spot FX market, guys, an institutional trader is buying and selling an agreement or contract to make or take delivery of a currency. A spot FX transaction is a bilateral, which just means two parties agreement to physically exchange, okay? This is why I say we're kind of in the realm of the spot FX, but we're not, because we're not physically exchanging one currency against another. This agreement is a contract, which means this spot contract is a binding obligation. So whether or not you win or lose, you have to physically take ownership of whatever you got. Kind of like what happened with oil not too long ago when it kind of went negative and people were left with that oil and they had to take physical delivery of it. That's what that is. That's spot FX, guys, okay? Let me see, blah, 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 blah. Which means this spot contract is a binding obligation to buy or sell a certain amount of a foreign currency at a price, which is the spot exchange rate or the current exchange rate. So if you were to buy Euro USD on the spot market, you are trading a contract that specifies that you will receive a specific amount of euros in exchange for United States dollars at an agreed upon price or exchange rate. It's important to point out that you are not trading the underlying currencies themselves, but a contract involving those currencies, okay? Even though it's called spot, the transactions aren't settled exactly on the spot, all right? In reality, while spot FX trade is done at the current market rate, the actual transactions not settled for 2 business days after the trade date. That's something that's called T+2, today plus 2 business days, right? There's a couple of more terms out there like that you don't really have to focus on. But again, guys, this is all good information to know because this sets your base to understanding what it is you're trading when you get down the road. It means that delivery of what you buy or sell should be done within 2 working days and is referred to as the value date or delivery date. For example, an institution buys Euro USD in the spot market, right? The trade open and close on Monday has a value date on Wednesday. This means that they'll receive euros on Wednesday, okay? But not all currencies are settled today plus 2 business days. USD CAD, USD Tri, USD Ruble, they're today plus 1 business day, right? They're T+1. Now, the retail Forex, this is where we dwell. This is for us poorer traders, right? This, like I said, is probably one of the newest parts of Forex. As I mentioned, like I said, we didn't always have access to the market, but thank God for the internet and brokers. They give us leverage. The secondary over-the-counter market that provides a way for, you know, the poor or the people who lack the liquid equity to participate in the Forex market is called, you know, for retail Forex. Access is granted by so-called Forex trading providers, quote, quote, or brokers. Forex trading providers trade in the primary over-the-counter market on your behalf. This is what I was mentioning you earlier. They trade in the spot Forex, okay? They find the best available prices, and then they add a, quote, markup before displaying the prices on their trading platforms. This is similar to how a retail store buys inventory from a wholesale market, adds a little bit of a markup, and shows a retail price to their customers. That's pretty much what a broker is doing to you guys. But technically, they're not brokers because a broker is supposed to simply act as a middleman, right? Between two parties, they're just supposed to connect you two, right? But that's not the case because a Forex trading provider acts as your counterparty sometimes. That means if you're the buyer, it'll act as a seller. And if you're the seller, it'll act as a buyer. That's a dealing desk broker. That's not a straight through process or an ECN. We will call them brokers, but it's still important to know the difference, guys, okay? Although a spot Forex contract normally requires delivery of currency within 2 days, in practice, nobody takes delivery of any currency in Forex trading. We just get the profit. The position is rolled forward on the delivery date, especially in the retail Forex market. Remember, you guys are actually trading a contract to deliver an underlying currency rather than the currency itself. So it's not just a contract, it's a leveraged contract. Retail Forex traders can't take or make delivery on leveraged spot Forex contracts. And leverage is what allows us to control large amounts of currencies with a very small deposit amount. And that's why I say the leverage is what's allow us to trade. All right, so retail Forex brokers let you trade with leverage, which is why you can open positions valued at 50 times the initial amount of the required margin. So all these things in yellow, guys, is what we'll get into here in a few moments. I'm going to explain what leverage is, try to give you some examples to help you guys understand the difference between margin and leverage. So with $2,000, guys, you can open up a Euro USD trade valued at $100,000. So imagine if you went short Euro USD and had to deliver that much worth of euros to somebody, right? Physically, like that would almost make me sick. But listen, you'd be able to, you'd be unable to settle the contract in cash since you only have 2,000 basically, right, in your account. You wouldn't have enough funds to cover the transaction. So you either have to close the trade before it settles or rolls over. To avoid this hassle of physical delivery, retail Forex brokers automatically roll their client positions. So that's why we don't physically have to do anything, right? But pay attention to these asterisks. When a spot Forex transaction is not physically delivered, but just indefinitely rolled forward until the trade is closed, it is known as a rolling spot Forex transaction or rolling spot FX contract. In the United States, the CFTC calls it a retail Forex transaction, okay? The reason why it's called a retail Forex transaction is because it's illegal. I mean, it's I don't know how to explain it too much, but a rolling spot Forex or a spot Forex contract that's rolling it's illegal to call it that in the United States. So that's why it's called a retail Forex transaction. All right. This is how you avoid being forced to accept or deliver 100,000 euros. The retail Forex transactions are closed out by entering into an equal but opposite transaction with your broker. For example, if you bought the British pounds with United States dollars, you would close out the trade by selling pounds for the United States dollars, okay? This is also called an offsetting or liquidating a transaction. Excuse me. If you have a position left open that closes at the close of the business day, it will automatically be rolled over to the next value date to avoid the delivery of the currency. And that's when you get into like swap fees and things of the sort. Your retail Forex broker will automatically keep rolling over your spot trade contract for you indefinitely until it's closed. And that's when you get into like swing trading holding things open for days, weeks, months, or whatever. The procedure of rolling the currency pair over is known as tomorrow next or time next, which stands for tomorrow and the next day. So if you guys, like I said, once you get deeper down the road, you all do this full time, you start talking with your trade buddies, you're gonna be able to understand what they're meaning if they're trading stocks or if they're like, hey, time next, right? These charges are known as a swap fee or a rollover fee. Your Forex broker calculates the fee for you and will either debit or credit your account balance. So guys, with a swap fee, yes, if the interest rate is right on that currency, whatever you're trading against, I think it's if it's positive, then you'll get some interest. You'll get some money added to your account. It's pretty crazy. Retail Forex trading is considered speculative. This means traders are trying to speculate or make bets on and profit from the movement of exchange rates. They're not looking to take physical possession of the currencies that they buy or deliver the currencies that they sell. There you go. So the last thing or the last way that you can trade currencies is a Forex spread bet. Spread betting is a derivative product, which means you don't take ownership of the underlying asset, but you speculate on whichever direction you think its price will move up or down. A Forex spread bet enables you to speculate on the future price direction of a currency pair. This is similar to what we are going to be doing, guys. A currency pair's price being used on the spread bet is derived from the currency pair's price on the spot FX market. Your profit or loss is dictated by how far the market moves in your favor or the number of pips that go in your favor before you close your position and how much money you have per bet, all right? So by the how much money you have bet per point means your lot size. Spread betting is on Forex is provided by spread betting providers. Unfortunately, if you live in the United States, spread betting is considered illegal despite being regulated by the FSA in the United Kingdom. The United States considered spread betting to be internet gambling, which is currently forbidden, okay? Now, you're probably like, so what does all that mean for you guys, right? It doesn't mean anything because we are in the retail Forex market. And it's kind of weird though, because Forex spread bet is describing how we make our money in the retail Forex market. We place our lot sizes, and depending on how far it moves in your favor, you count the pips. Depending on the pips value at your lot size, that's how you make your money, right? So it's yeah, guys, don't worry about it. What is a Forex CFD? It's a contract for difference. A contract for difference, or CFD, is a financial derivative. Derivative products tracks the market price of an underlying asset so that traders can speculate on whether the price will rise or fall. The price of a CFD is derived from the underlying asset's price. A CFD is a contract, typically between a CFD provider and a trader. I would say, I know you guys are well, you probably guys don't know about US 30 yet with a broker. That is more of a CFD than it is, I guess, like a currency pair, if that makes sense. It's actually an indice or a future, I would say, and on any other broker like a Ninja Trader, but for tonight we'll call it a CFD. Pays out a little bit different as well. A CFD is a contract typically between a CFD provider and trader, where one party agrees to pay the other the difference in the value of a security between the opening and closing of a trade. So in other words, it's basically a bet on a particular asset going up or down in value with the CFD provider, and you agree to pay, and the CFD or you basically agree to whoever wins that bet will pay the other the difference between the asset's price when you enter the trade and its price when you exit the trade. Forex CFD is a agreement or a contract to exchange the difference in the price of a currency pair from when you open your position versus when you close it. So it's, again, guys, it's counting pips basically, right? It's just a different way to trade a security. A currency pair CFD price is derived from the currency pair's price on the spot FX market, or at least it should be. If not, then what is the CFD provider basing its price on? You got to watch out for these brokers sometimes. Let's see. Trading Forex CFDs allow you to hedge or trade in both directions. You can take both long and short positions, both buy and sell. If the price moves in your chosen direction, then you would make a profit, and if it moves against you, you would lose. In the EU and the UK, regulators decided that rolling spot FX contracts are different from traditional spot FX contract. The main reason being is that with the rolling spot FX contracts, there is no intention to ever take actual physical delivery or ownership of a currency. Its purpose is to simply speculate on the price movement, all right, in the underlying currency. And that's what we do. The objective of trading a rolling spot Forex contract is to gain exposure to price fluctuations related to the underlying currency pair without actually owning it, right? So this is when you get into like US 30 and index, right? Usually that's a security that you have to have a lot of money and equity, honestly, to trade. But due to leverage and things like that off of your brokers and how it's set up, it allows us to speculate on it. So to make this differentiation clear, a rolling spot FX contract is ruled as a CFD, but in the United States, CFDs are illegal, so it's known as a retail Forex transaction, right? It's the same thing, it's just not called a CFD. In the United States, we call it a retail Forex transaction. Forex CFD trading is provided by CFD providers. Some brokers are, a lot of it is provided, I would say, outside the United States or offshore. Outside the United States, retail Forex trading is usually done with CFD or spread bets. Okay, so with Owanda, you're not really doing CFDs or spread betting. With KOTFX, you're doing a combination of both. All right. Any questions so far before we go to how to make money?
Can you say exchange a few more times?
I know, right?
Every time you say it, I'm like, ding. Yeah, but no, you're dropping some sauce. I hope people are taking notes.
Bro,
and,
the foundation's got to be solid, man. I can't build these people up on no sand. You know what I'm saying?
Yes, sir.
All
Let's keep going. Yes, let's keep going. All right, yeah, another quote. Instead of worrying about what you cannot control, shift your energy to what you can create. That's from Roy T. Bennett, The Light and the Heart book. All right. So what that quote means, how I relate that to Forex, right? In Forex, guys, understand you cannot control none of this shit. you cannot create, you cannot control any of it, guys. I don't care how good or how 100% the price may be on your confluence, you can still lose. Okay. But it's important to shift your energy from being negative when you do lose to be like, okay, cool. What can I create now from this? What did I learn from this? Right. And that's what that quote means. So how do we make money with this? It's bag season. All right. Placing a trade in the foreign exchange market is simple. The mechanics of a trade are very similar to those found in other financial markets. The objective of Forex trading is to exchange one currency for another in expectation that the price will change. So here's an example, right? You purchase 10,000 euros at the euro. I'm down here at the very bottom of trader action, actually. Oh my gosh, I messed that up. My chart's messed up, guys. So I need to correct that. So down below that, you purchase 10,000 euros at the Euro USD exchange rate of $1.18. Okay. Let me get this correct, actually. I can't use that example right now. Okay, so we'll use another example. We'll skip that part. So how to read a quote. Hey, Brian, can you make a note that I need to correct that, please? Appreciate you. All right, how to read a quote, guys. So
Part, say it again. Which part? I'm sorry.
It's the example, the Euro USD example on how do we make money.
All right. That it needs to be changed.
Yeah, I need to fix it.
All right. Fix.
Appreciate that.
You on how to make money?
Yep.
Yep.
All right,
Put
cool.
the slide number.
That's a good question, honestly. Boom. Slide number 23.
Got it.
All right. So how to read a quote, guys. The picture to the right is a currency pair. We're looking at the British pound versus the United States dollar. The British pound is the base currency and it's quoted against the United States dollar. That's the quote currency, okay? Currency pairs are always quoted in pairs, such as GBP USD, United States yen. The reason why they're quoted in pairs is that in every foreign exchange transaction, you are simultaneously buying one currency and selling another. Whenever you have an open position in Forex trading, you are exchanging one currency for another, all right? Currencies are quoted in relation to other currencies. That's why you have a base currency and a quote currency, all right? So here's the example. The first listed currency to the left of the slash is also known as the base currency. That's the British pound. This is the reference element of the exchange rate for the currency pair. It always has a value of 1. Okay, so what this quote says, for 1 British pound, you have to pay $1.21 and some odd change, right? Or some odd pips, I'm sorry. The second listed currency on the right is called the counter or the quote currency. And this example is United States dollar. When buying, the exchange rate tells you how much you would have to pay in units of the quote currency to buy 1 unit of the base. So you have to, again, you have to pay $1.21 and some odd pips to get 1 British pound, basically. All right. When selling, the exchange rate tells you how many units of the quote currency you will get for selling 1 unit. So if you was to sell, you would get, for 1 pound, you would get $1.21. Okay. Within this currency quote, there's a few different things that we have to pay attention to. And that is the bid price, the ask price, and the spread. You're either going to go long or short, guys. Okay. Going long is you're bidding. Going short, you're asking, kind of like an auction, right? If you're selling something at auction, you have an asking price. And then if you want to buy something at auction, you have a bid price, right? All Forex quotes are quoted with 2 prices, the bid and the ask. In general, the bid is lower than the ask price. The bid is the price at which your broker is willing to buy the base currency in exchange for the quote currency. This means that the bid is the best available price at which us, the trader, can sell to the market. If you want to sell something, the broker will buy it from you at the bidding price, all right? The ask price is the price at which your broker will sell the base currency in exchange for the quote currency. This means that the ask price is the best available price at which you can buy from the market. Another word for an ask price is an offer. If you want to buy something, the broker will sell or offer it to you for the ask price. All right. Now, the difference between the bid and ask price is what is known as the spread. That's how some of these brokers make their money. Okay. On this picture to the right, the spread is actually 2 pips. That's the difference between the bid and the ask price. All right. If you want to sell euro, you click sell and you will sell euros at $1.34, some odd pips. If you wanted to buy the euro, you click buy and then you're going to buy the euro at $1.34 and some odd pips. But notice the difference between the 2 numbers. The sell has a 0.34568. The buy has 0.34588. That is a 2 pip difference. And we'll get into counting pips later. Here's where we get into the good stuff, man. Lots and margin, okay? What we do with the brokers is, I guess, called trading on margin or margin trading. It's like when you go to the grocery store and you want to buy an egg, okay? This is how I explain a lot. If you go to the grocery store and want to buy an egg, you can't just buy a single egg, right? They're going to come in dozens or lots of 12. So in Forex, it's going to be just as foolish to try to just buy or sell one single euro. So they're going to come in lots of 1,000 units of currency, which is a micro lot. They're going to come in a lot of 10,000 units of a currency, which is the mini lot, or they're going to come in 100,000 units of that currency, which is a standard lot, okay? So that's going to depend on how much equity you have in your account, how much, what you have your leverage is and things like that. That's going to determine what lot size you can take, whether you want to be super risky or not, all right? But you can trade still by using leverage. So we don't have to have that much equity. We don't have to have $100,000 in our account, right? Because of leverage, guys. When you trade with leverage, you wouldn't need to pay the 10,000 euros up front. Instead, you put down a small deposit, quote, quote, deposit. That deposit is known as the margin, okay? And this is where we get into the difference between what is margin versus leverage, right? So again, instead of putting up the full 10,000 euros on your lot size, right? They take what is called a deposit or a margin out of your initial deposit into your account. So leverage is the ratio of the transaction size or the position size or your lot size, right, to the actual cash or the trading capital used for the margin. So for example, on 50-to-1 leverage, which is the max, well, I'm not gonna say it's the absolute max because you can get 100-to-1 leverage here in the United States, but more times than not, you're only going to be offered off the jump 50-to-1 leverage, okay? So for example, 50-to-1 leverage is also known as a 2% margin requirement, okay? That means $2,000 of margin is required to open a position worth $100,000. So what that means is if you use Owanda, okay, and you want to use a full standard lot size to trade, you have to understand that you're going to have at least $4,000 in your account, okay? Because they're going to pull $2,000 from that 4,000 in order to open up that position size. So you're going to be kind of over leveraged or risky trading, I would say, okay? Margin trading lets you open large position sizes using only a fraction of the capital you normally need. So this is how you're able to open, $1,250 or $50,000 positions with as little as $25 or $1,000. It's because of the leverage. That's one of the reasons why I use KOTFX and Owanda. KOTFX offers the leverage that I like and that I want to use versus Owanda. Boom. Again, but I don't have enough money to buy 10,000 euros. Can I still trade? Yes, you can by using leverage. All right, so let me explain. So you believe that the signals in the market are indicating that the British pound will go up against the dollar, right? You open a one standard lot, which is equal to 100,000 units of British pound versus the dollar, buying with the British pound with a 2% margin requirement, okay? You wait for the exchange rate to climb or go up. And when you buy one lot or 10,000 units of the GBP at a price of $1.50, you are buying 100,000 pounds, which is worth $150,000. Okay, so the math is 100,000 units of the British pound locked in at $1.50. Okay, so since the margin requirement was only 2%, then $3,000 would be set aside in your account to open up that trade. Okay, instead of 150,000 being required because of leverage. All right. So now you control 100,000 pounds with just $3,000, guys. And if your predictions come true and you decide to sell, you close that position at what you did, what, 5 pips? That's $500. I mean, oh no, that's 50 pips. That's $500. I'm sorry. You guys following that?
Not necessarily.
Well, let me well, ask a question. What do you want to understand?
I'm just so if you lose that bet, if you lose that trade, that means you're gonna owe that money back then?
It's deducted from your account.
Ah.
$3 grand.
So what if you don't have the $3 grand in there? Then you owe somebody some money.
No. I'm sorry. So check this out. So you have this trade is at just a standard, right? It only went up 50 pips. This is when stop losses and things come with you, right?
Yeah.
So the 3,000 is just the margin required to open that. If you win or lose that trade, that's put back into your account. Okay. But let's say if this trade goes against you, this 50 pips, they're going to take 500 from that before they put it back into your account because you lost.
Okay.
Does that make sense now?
Yeah.
Got you.
Yeah, so he's going super in depth, so that way you guys understand everything.
Right.
Not a lot of people will do this to where you actually understand what happens when you place a trade and
Exactly.
everything. So,
This is what this is all about, guys. Trying to get you guys to understand the concept of what you're actually doing. The more you're understanding this, the more you'll have a different mentality about it, and you'll think about it more of like a business than a hobby, and you'll actually hone in on it because you guys have to understand, like, this is a business transaction that you're actually conducting, right? You have to think about it like that. So what I'm trying to give you is like the whole situation of what's going on and explain all the concepts, like the margin, like how does margin work? Like a lot of people are out here trading, but they don't really know the difference too much between margin and leverage. So I just wanted to just be in depth with it and give it all under the table. So you could have lost that 500 as well, being on the wrong side of the trade, right? All right, good shit. Forex terminology. Now let's get deeper into it. Let me see real quick. Boom. Yeah, this is, can everybody hear me?
Yeah.
All right, cool. Because somebody said they couldn't hear me. So yes, this is being recorded, guys. So the increase or decrease of the pips determine the amount of gain you lose. The increase and decrease in the pips times your lot size determine how much you're going to gain and lose. So yeah, you're correct, Christina. You just had to go deeper with that. All right, let's keep going. What am I on? 29? Shoot. All right, Forex terminology. Now, what are we actually speculating on, guys? We're actually speculating on the movement or price of a currency, but the movement is so small, guys. It's of the fraction of a penny. Okay, it's called a 20%. That's what a pip is. Okay, so you've probably heard of the terms pips, points, and pipettes, and lots thrown all around already. But now we're going to go explain to what they are and show you how their values are calculated. So again, guys, take your time with this information. This is required knowledge for all Forex traders. All right, this is your foundation. Understand that. So don't even think about trading until you're comfortable with pip values. Like if you can't really understand what a pip is, guys, like don't try to risk your money or anything like that. It wouldn't make sense, right? So what is a pip? The pip is a unit of measurement that to express the change in value between two currencies. All right. So if Euro USD moves up from $1.1050 to $1.1051, that 0.001 rise is 1 pip. Okay. A pip is typically the last decimal point of a price quote, but Some brokers and some currency pairs go out five decimal places. Some only have two, like the Japanese yen pairs. Okay, so for example, Euro USD has 4 in this example, 4 decimals. USD JPY, it's only got 2. There are Forex brokers that quote currency pairs beyond the standard 4 and 2 decimals. Some of them do to the 5th. If they do it to the 5th decimal spot, guys, that's a pipette. All right. So this is where you have to understand. I think, on social media, some of these people actually count the pipette as a pip and not really know the difference between them all. Right. I'm trying to give the whole game to you guys. I told you I was giving you sauce for free. I'm giving you all the sauce, right? They are quoting fixed or fractional pips, also called points or pipettes. If the concept of a pip isn't already confusing for you enough, let's try to make you even more confused by pointing out that a point or a pip is equal to 1/10 of a, or a pipette, I'm sorry, is equal to 1/10 of a pip. So for instance, if British pound US dollar moves up from 1.30542 to 1.30543, that 0.00001 move is higher. That's 1 pipette. All right. So in that picture to the right, the 30543, that 3 is the pipette. The 4 is a pip. So if you were, if you were looking at a price chart, right, and you wanted to mark up some structure or count your pips, this is how you would break it down, right? So let's say the 1.1538, the 382 moved up to 1.18382, right? That's 1,500 pips. Okay, so that's a cheat sheet for you guys. Print it out. Now, this stuff right here isn't necessarily anything that you guys have to manually do. Okay, it's automatically done for you by your broker, but it's good to know the difference between the value of the pips because they're not all the same, right? The value of 1 pip is not going to be the same across all the trade instruments you're able to trade. Okay, it's all relative to its own value. And again, the broker is usually doing this for you. In the following example, we'll use a quote with 4 decimal places. All right. And for the purpose of better explaining the calculations, we've got the exchange rates expressed as a ratio. So for Euro USD at 1.25 will be written as, so for 1 euro, it's equal to 1.25 USD. All right. Example number 1. We've got the United States dollar versus the Canadian dollar. And the Canadian dollar is equal to 1.0200, right? That's to be read as 1 United States dollar to 1.02 CAD or 1/1.02 CAD, right? The value change in counter currency times, this is how you calculate a pip basically, right? This is what the broker is doing for you. You guys, again, this isn't anything that you all have to really know too much, but again, it's good to understand that, not all these currency pairs are valued the same. This is what all this is breaking it down to you, okay? So you've got the value change in the counter currency times the exchange rate ratio. That's going to equal the pip value in terms of the base currency. So you've got 0.001 Canadian dollar. That's the change that we have in the counter currency, okay? We're going to multiply that by the ratio of, for $1, it takes 1.02 Canadian dollars, okay? Or simply as, there's the whole calculation down there, 0.001 Canadian dollars divided by 1.02 Canadian dollars times $1. That's going to give you a pip value of 0.00009804 United States dollars per unit traded, or the value of 1 pip United States dollar. Okay. So if you was to put a well, it's down below. Using this example, if we traded a 10,000 units of the USD CAD, then then a 1 pip change to the exchange rate would be approximately 98 cents. Okay. And there's the math right there. 10,000 units times the 0.00009804 United States. That's per pip. So let's say it went up to, let's make it easy for you guys. So let's say you caught 10 pips at 10,000 units, right? Then you multiply that 10 pips by the 0.98, and that's going to give you a total amount. And once you have that total amount, you subtract the spread times that same pip value, and that's what the broker is going to, I guess, make off you, right? If you trading with a spread, the broker makes his money off the spread. That's how much money is going to be taken from your profit, basically. And we say approximately because the exchange rate changes, and so does the value of each pip move. Example number 2, the British pound versus the Japanese yen. So on this example, though, notice it's not quoted out to 4 decimal spots. It's only quoted with 2. Notice that this currency pair only goes to 2 decimal places to measure a 1 pip change in value. Most of the other currency guys are going to have 4 or 5 decimal places, depending on your broker. So in this case, a 1 pip move would be 0.01, the last spot, right? That's a 1 pip move. So how you calculate the value of this, again, it's similar to what we just did. You take the value change in the counter currency. We'll just say 0.01 as a 1 pip move. You times that by the exchange rate ratio, and that's going to give you the pip value. The exchange rate ratio is for 1 British pound, you get 123 Japanese yen. All right. So a 1 pip move, the value of 1 pip move at 10,000 units is approximately 81 cents in British pound, or 81 British pounds. I'm sorry. Very similar to what we just did, guys. It's just not as many decimal spots. All right. So what is a lot? A lot is, again, guys, it's your units of currency. Forex is commonly traded in specific amounts called lots, right? Or basically the number of currency units you will buy or sell. The standard size for a lot is 100,000 units. That's the 1.00, right? And now there are also, you've got a mini, micro, and nano. Guys, you're not going to be on a broker that's going to let you trade nano lot sizes. The lowest is going to be micro, okay? So you've got 1.00, which is 100,000 units. You've got 0.10, which is 10,000 units. Then you've got 0.01, which is 1,000 units. You're not going to be able to trade with any broker that's going to allow you to trade just 100 units. Some brokers show quantity in lots, while others show the actual currency units. Okay, a lot of the times you're just going to see it in lots more time than the other. As you already know, the change in a currency value relative to another is measured in pips, which is a very, very small percentage of a unit of currency's value. It's the fraction of a penny, guys. That's what we're speculating on. To take advantage of this minute change in value, you need to trade large amounts of a particular currency in order to see any significant profit or loss, thanks to leverage. All right, example. Let's assume we'll be using a standard lot size, or we'll be using 100,000 units, right? The United States dollar, Japanese yen at an exchange rate of 119.80. Okay, so we're calculating the value of what a pip is, right? So for 1 pip move, you're going to get paid $8.34 on the USD JPY. All right. But if you get a 1 pip move on the United States dollar Swiss franc, it's only going to pay you $6.87 per pip. So let's do some math, right? Let's say, because what I'm theoretically teaching you guys starting out, you know, or what the focus on is 20 to 30 pips, right? So let's say you caught 30 pips at a full standard. You multiply 30 by on the United States dollar JPY. You multiply 30 pips times 8.34, and you're going to get $250.20 approximately. Once they take out the spread, you'll have, you know, what, 245 or something like that, right? That's a pretty good win right there, right? 30 pips for that, probably risking what? More times than not, what I have you guys risk is a risk to reward ratio is a minimum of 2 to 1, right? So if you're only risking 15 pips to catch 30, right? So let's do that real quick. 15 times 8.34. So you're risking $125 to basically make a minimum of 250. That's a 2 to 1 risk to reward ratio, right? And that, again, guys, all this is automatically done by your broker. But again, it's good to know that, hey, even though I'm placing a standard, it's not going to be the same value on this pair versus another. Okay. So you have to understand that and be careful when you're trading, because your risk management, depending on what you're trading, again, guys, is going to be different. In cases where the United States dollar is not quoted first, this formula is just slightly different. All right. So if you were to, I guess, buy the Euro USD at an exchange rate of 119.30, 1 pip move on that one is equal to 8.34 times the excuse me, the 1.1930, which is the exchange rate for the dollar. Okay. So that's going to be rounded up to $9.99 or rounded up to the $10 a pip, basically, right? The $9.99 is the 838, which is the value of 1 pip move times, okay, no, it's the 838, which is the value of 1 pip move, but you multiply that times the exchange rate of the United States dollar, and this is what you're going to get, but they're going to round that up to $10 per pip. Okay, same with the GBP USD. So it's almost safe to say is whenever the United States dollar is quoted second and you place a full standard, you'll get $10 per pip. But when it's quoted first, it pays a little bit differently. And the reason that is because, again, guys, you are simultaneously buying and selling something. So when you close your order out, you know, you just sold something or something, right? So that's where this comes in at. Now, leverage, the double-edged sword, is going to cut you guys, all right? So again, you're probably wondering how, you know, we're able to make money with small amounts of initial startup, right? So think of your broker as a bank who basically fronts you $100,000, guys, to buy currencies. All the bank asks for you is that you give it $1,000 as a good faith deposit or your margin, right? Which it will hold for you, but not necessarily keep. The amount of leverage you use will depend on your broker and what you personally feel comfortable with, guys. I personally, like I said, I use Owanda. They offer, I use them at 100-to-1. And then I have KLT FX. They offer as high as 500-to-1, okay? Typically, the broker will require a deposit, or also known as margin. Once you have deposited your money, you will then be able to trade. The broker will also specify how much margin is required per position or lot traded. So again, the margin required to place a trade varies from instrument to instrument and varies from the lot size. For example, if the allowed leverage is 100-to-1 or 1% of the position required, and you wanted to trade a position worth $100,000 or 100,000 units, but you only have 5,000 in your account, right? No problem, as your broker would set aside $1,000 as a deposit or your margin and let you borrow the rest. And of course, any losses or gains will be deducted or added to the remaining cash balance in your account. The minimum security or the margin for each lot will vary from broker to broker, guys. And again, that 1,000, guys, it's not a fee. It's your deposit. You get that back when you close your trade. The reason the broker requires a deposit is that while the trade is open, there's risk that you could lose money on that position. All righty. What more math? How to calculate profit and loss. So now that you know how to calculate the value of a pip, right? And again, guys, all this is automatically done for you, but it's good to know what you're actually doing. Let's look at how you actually calculate your profit or loss. So we're going to buy the United States dollar and sell Swiss francs. The rate that we're quoted is 145.25 for a dollar, 145.30. That's your bid and ask price. Okay. So because we are buying United States dollar, we're going to be working on the ask price of 145.30, the rate at which traders are prepared to sell. Okay. So if you buy one standard lot or 100,000 units at 145.30, a few hours later, price moves to 145.50. You decide to close your trade. That's 20 pips. You just won 20 pips. Okay. The new quote for the USD chef is 145.50 or 145.5. That's your bid and ask price since price moved up, right? Since you initially bought to open the trade and to close the trade, you must now sell in order to close it. You sell at that 145.50. You sell at the bid price, or you close your trade at the bid price. Okay. It's kind of confusing, guys, but just understand that you bought at 145.30, okay, which was your initial ask price, okay, and you closed the order at 145.50, which is now the new bid price, okay, so you gained 20 pips. So using the formula from before, we're now at what? $6.87 per pip. Multiply that by 20 pips. $137.40, guys, is your take home money. Minus, I guess, what this any kind of fees or anything like that, depending on your broker you're trading with. You guys exhausted yet? Y'all need to take a break? Any questions? If so, please open up right now and ask.
Yeah, I didn't see any questions yet come in.
So what I mean by pullbacks is as this is going down, right?
Do what?
Different color.
I didn't see it. There's none in the chat yet.
Oh, okay, cool. Oh, that's Brian in the background. I was like, what the hell?
Yeah, my bad. I'm trying to pay attention to his and moderate ours as well.
Oh, no doubt. I appreciate you, bro.
I got to support Ryan. You know, I had to at least log on and have it in the background.
I wish I was on there, but it's all good.
Yeah, many more to come.
Yes, indeed. All right, so where are we at? I need to figure out where we're at. We only got a few more slides, guys, for tonight. Probably about 8 to 12 more, I think. So we've already covered, guys, you know, what Forex is, who trades Forex. We've covered, you know, how do you make profit or how do you trade the Forex market? Now we're going to put you in, when do you trade? Because I told you guys already, it's a 24-hour market, right? But that doesn't mean it's always active the entire day. You can make money trading when the market moves up or when it moves down. But when it's moving flat or sideways, guys, it's very difficult to try to make some profit in that. So you don't want to try to trade in certain times of the day, all right? And believe us, there will be times when the market is as still as the victims of Medusa. And I kid you not, it'll just be going sideways and you'll just be frustrated. And that's when it's time to call it quits for the day and just do something else. So before looking at the best times to trade, we must look at what a 24-hour day in the Forex world looks like, okay? The Forex market can be broken up into 4 major trading sessions. You've got the Sydney session, You've got Tokyo session, you've got the London session, and of course, you've got Trump's favorite time to tweet, the New York session. It goes haywire in the New York session, guys. Historically, the Forex market has 3 peak trading sessions. Traders focus on one of these 3 trading periods rather than to attempt to trade 24 hours a day. You never want to trade, guys. I mean, 24 hours a day. Matter of fact, like, honestly, unless you're practicing or trying to hone your skills, you shouldn't be trading. I personally would say no more than 6 hours a day. I personally look at the charts between, I'm gonna say, as early as 10 p.m. as late as 12:30 a.m. for the London session, and then I'll look in the mornings from like 7 till about 10:30 for the New York session. And then, you know, that's in between 5 to 7 hours. That's all it takes, guys, to make money, right? Traders often focus on one of these 3 periods, like I said, rather than attempt to trade 24 hours. This is also known as the Forex 3-session system. The 3 main sessions actually traded, guys. You've got your Asian session or Tokyo session. You've got the European or London session, and you've got the North American or New York session. There you go. Some traders prefer to differentiate the sessions by the names of the continent, while others prefer to use the names of the actual cities where the exchange is located. So here are the summer hours. This is also in Eastern Standard Time, guys. Okay. So you've got the Sydney or the Australian opens at what, 7 a.m., closes at 4 p.m. That's in Sydney, right? So for us, it opens at 5 p.m. Sunday, closes at 2 a.m. Monday. Tokyo opens at 8 p.m., closes at 5 a.m. London opens at 3 a.m., closes at 11 a.m. New York opens at 8 a.m., closes at 5 p.m. And then after New York closes, guess what opens? Sydney opens right back up, guys. So notice though, some of these trade times overlap. Okay, those are the winter hours. This is for like Eastern, when you have daylight savings and stuff like that. Now, trade session overlaps. Just a second. That's funny. All right, so trade session overlaps, guys. Take notice that in between each Forex trading session, there's a period of time where 2 sessions are open at the same time. For example, in the summer, guys, we had 3 a.m. to 4 a.m. You've got the Tokyo session and the London session overlap. And then both in the summer and the winter, the London session and the New York session overlaps, okay? Naturally, these are the busiest times during the trading day, guys, and there's a lot of volume and liquidity when the 2 markets are open at the same time. These times are when you kind of want to be trading or looking for your trade, I should say, okay? This makes sense because during those times, all the market participants are willing and dealing, which means there's a lot more money transferring hands. Where do you find that at? Bro, send me that picture. Holy crap. My brother just showed me a picture from my oldest daughter when she was like not even 1, I don't think. Like, holy crap. I haven't seen a picture in forever. Sorry about that. All right. See. Now let's take a look at the average pip movement of the major currency pairs during each Forex trading session. All right. So in Tokyo session, this is from 5 p.m. to what, 2 a.m.? This is the Tokyo session. The Euro USD moves an average of 76 pips. GBP USD, an average of 92 pips. USD JPY, an average of 66 pips. And that's what this chart is, and that's how this is read. In the London session, damn, Euro USD, Euro London, right? Kind of moves a lot. So as you guys can see, like the currencies that correlate with Tokyo, Japanese yen or Australian session, Australian dollar, you want to trade those when that trade house is open, right? You're going to get a lot more movement. Euro or United States dollar, right? Moves heavily in the London session because it's a euro, right? What's predominant in London? Euros, right? Let's see. And that's how you pretty much just use this chart, guys, but we'll go deeper into that. Best times to trade. Let's get it. You want the London Tokyo overlap. Liquidity during this session is pretty thin for a few reasons, okay? Typically, there isn't as much moving during the Asian session. So once afternoon hits, it's pretty much a snooze fest, or afternoon over there in Japan, Tokyo, right? With European traders just starting to get into their offices, trading can be boring. The London trade or the Tokyo London overlap, guys, this is where I look to set my pending orders and go to sleep. This is the in between 10:30 p.m. and 12:30 a.m. is when I'm looking to set my orders and I go to sleep. This is going to be some powerful shit I'm going to teach you guys, okay? So like I said, it's not like you're watching charts at all day. Now I am going to warn you guys, once you start to pick up on this shit, you're going to want to look at charts all the freaking time. It's addicting. The second best time to trade is the London, New York overlap. This would probably be the absolute best, all right? And the reason why that is because it's at an optimal level. Like you've got pretty much the two largest trade exchanges open at the same time. According to the latest data from FX Liquidity, that's an analytics service for the Forex market, the liquidity is at an optimal level around 10 a.m. and 3 p.m. London time, or 10 a.m. New York time, okay? So this is when the real shebang begins, basically. You can literally hear traders crack their knuckles during this time because they know they have their work cut out for them, guys. It's hustle and bustle, when in the mornings from 7 a.m. Eastern Standard Time to about 10:30, 11 a.m., guys, when London closes. It's hustle and bustle, okay? Like I said, this is when the biggest time of day is traders from the two largest financial centers, London and New York. They're duking it out, guys. It's during this period is where we can see some big moves, especially when news reports from the United States and Canada are released, or when Trump speaks. The markets can also be hit by late news coming out of Europe. So I will warn you guys against the London-Tokyo overlap. It can be very hectic for a new trader because, again, it's a lot of news releases, all right? And news does affect this market if you don't, well, I'm not going to say it doesn't. It does affect this market, and if you don't know how to properly read the news or understand what type of news is going on, like, you could be hit. So I do want to warn you guys, like, if there's ever a news release and you are in a order, if you don't feel comfortable, secure your profit, okay? And we'll go deeper into this later, though. If any trends were established during the European session, we could see that trend continue as U.S. traders decide to jump in and establish their positions after reading what happened the previous day. You should watch out, though, at the end of the session, as some European traders may be closing their positions, which could lead to some choppy moves right before lunchtime in the United States. This is why I say I look at the charts for New York session in between 7 and about 10:30, right? Because after that, guys, I mean, the liquidity is going to die down. The moves become pretty slow unless there's a news release. The best days of the week to trade, I'm pretty sure you guys have some of you all have probably heard Caesar say he doesn't trade every day. He trades certain days, and this chart explains why, okay? So not only are there certain times to trade, guys, or best times to trade, there's best days to trade. So imagine trading, on a Tuesday morning in the London-New York overlap. Like, the pip movement is huge, okay? And we're not even trying to catch all these pips. We're not trying to catch 142 pips off one move. Not just jumping off the gun, or not just being new traders or anything like that, guys. I can show you how to catch 142 pips off a single move, but we're focused on 20 to 30 pips. Once I know that you can secure 20 to 30 pips, guys, then that's when you jump up to the big boys, become a swing trader, because you've built that confidence. You have to start small and build into that. I personally wish I can teach you guys how to swing trade, which I think I'm going to try to for the most part, but I want you guys to focus on catching 20 to 30 pips just starting out. So that way you see progress, basically, because some swings take days to play out, right? And as a new trader, your emotions are going to be haywire. They're going to be all over the place. But back on track. Fridays are usually busy until about 12 p.m. or lunchtime, and then the market pretty much drops dead until it closes at 5. This means that we only work half days on Fridays. More times than not, I don't even trade a Friday, guys. More times than not, I won't even trade Sunday night or Monday morning. I'll wait till Monday night, and I'll trade all the way until Thursday night.
Yeah, that's pretty much how me and Caesar do it over at the Exchange too.
Is it?
Yeah, for the most part, yeah. We have super similar.
I already know, bro.
Well,
it's dope.
But yeah, that's how we do as well. We do Monday night into Friday morning.
Yeah.
Like London Thursday night.
Yeah, London Thursday night. Exactly. That's about it, guys. That's really all you need. It's like I said, you're not really out here trying to slaughter the markets. You just imagine catching. Let's keep this in perspective, right? So let's say you trade Monday night through Thursday night, right? So you've got Monday night session, which is 1, Tuesday morning, then you got Tuesday night, Wednesday morning, Wednesday night, Thursday morning, Thursday night. That's 7 trade sessions, guys, right? So if each session you catch, let's say 30 pips. Where's my phone? Let's say each session you catch 30 pips, right? Multiply that by 7, that's 210 pips. If you were trading Euro USD at a full standard and you caught 210 pips, guys, for that whole week, bro, that's $2,100. I mean, so guys, you don't have to, like I said, you're not going to get rich overnight, but you can honestly make a lot of money kind of quickly. And I don't want to try to hype it up or anything like that, but I mean, that's just the reality of it all, right? Like I said, we're not focused on catching all the 442 pips. Guys, focus on your 20 to 30 per session and keep it moving.
That's all you need, man.
That's all you need.
And Wallace, you can't beef it up, but you don't want to hype it up, but you also don't want to hype it down either, because
right, exactly.
What you're saying is I mean, true. Like, you literally can trade 3 days a week, and don't let greed take over. 3 days a week, and you guys can be very profitable traders based on the percentages. So like he was saying, pips don't really matter how many pips you make. What matters is your percentages for your win risk reward ratio, not the pips. So definitely don't focus on, I need to catch 100+ pips to really make a lot of money. That's not the case at all.
That's not the case at all, guys. And that's what we're trying to get you guys to understand, and that's why I put that quote, start with what you have and do what you can. You know what I'm saying? Because that's going to grow, guys, real quick. Like, if you start, let's say, with $500 and you really hone in and master this shit, you can honestly turn that $500 into whatever you want. So let's see. Recap. Again, the best times to trade are when 2 sessions are overlapping. These are also times when major news events come out to potentially spark some type of volatility or directional movements. Make sure you bookmark the market hours cheat sheet, guys, once I release this, once I release it. You can download it and print it out. And then take note of the opening and closing times. The European session tends to be the busiest out of the 3. The middle of the week typically shows the most movement, and as the pip range widens for most of the currency pairs. Some of the worst times, Sundays. Everybody sleep. They're enjoying their weekends. The people aren't even at their brokerage here in the United States or anything like that too much. Again, it starts in where? It starts in Sydney. Okay. Fridays, liquidity dies down during the latter part of the United States session. So if you're trading Fridays, Friday mornings. After that, go enjoy yourself. Holidays, guys. Nobody's typically trading on a holiday, and most I would say major players, they're taking a break. Okay. Major news events. If you aren't comfortable with trading news, or if you just, let's say, entered a position a few hours before news, guys, you don't want to really trade that. If you're new, you don't want to get whipsawed, right? And a whipsaw means just like a quick movement that hits your stop loss and takes you out of your position. When you just broke up with your significant other because you chose trading Forex over him or her, yeah, just wait till the next London session, man. The reason why that's in there is because this is such a mental thing, guys, that, yo, if that bothers you, if you break it up with somebody bothers you, it's going to bother you trading, okay? It's going to open up the door to a lot of emotions. Let's say when you lose, you're already pissed because you just got broken up with or you broke up with somebody, right? Now you're losing your money too. Just don't do it. All right. So why do we want to trade Forex, right? What's so special about the Forex market? Well, it offers actually a lot. It's a big players market. There's no commissions. There's no clearing fees or exchange fees, no government fees, no brokerage fees. Most retail Forex brokers are compensated through the services by the spread, right? There's no fixed lot size. In the futures market, the lot or the contract size is determined by the exchanges. For example, a standard size contract for a silver's future is 5,000 ounces. In Forex, you can trade smaller lot sizes or position size. That allows traders to open trades with as small as 100,000 units. So could you imagine having, that's crazy. That's crazy. Anyways, low transaction cost. The retail transaction cost, the bid ask spread, is typically less than 0.1% under normal market conditions. The spread will widen or get bigger, and it will decrease at times too. For larger transactions, the spread could be as low as 0.07. But again, guys, this all depends on your leverage and your broker, and all that stuff's going to be explained later. Where did that go to? It's a 24-hour market. There is no waiting for the opening bell. There's no waiting for a closing bell. Guys, you can trade the shit, like I said, from Sunday night to Friday evening, but it's not recommended. This is also for those who want to trade on a part-time basis, because you can choose when you want to trade, morning, noon, night, during breakfast, or in your sleep. We all know that there's a quote that says, you know, some of the wealthy people make money in their sleep, right? Guys, I'm about to give you a system to make money in your sleep without owning an actual business. Keep that in mind. No one can corner the market. The FX market is sufficiently liquid. It generates now, I think, in between 5 and 7 trillion bucks in a single day. So guys, the money's there, right? There's enough for the whole world pretty much to get a billion bucks, almost damn near. It's not, the FX market is sufficiently liquid by significant manipulation by any single entity, and is all but impossible during active trading hours for the major currencies. So what that means is the market is and can be manipulated, guys, but it's not always manipulated like 24 hours a day or anything like that. So when the banks like JP Morgan, the central banks and shit like that get hit with fees, it's because they were doing like market manipulation, right? It doesn't happen a lot from those players, but I will tell you this: your broker, if it is a dealing desk broker, yes, you probably will face a lot of manipulation, because again, they make their money by you losing. Okay. The foreign exchange market is so huge and has so many participants that no single entity, not even a central banker or the mighty Chuck Norris himself, can control the market price for an extended period of time. Another reason is leverage. In Forex trading, a small deposit can control a much larger contract value. Leverage gives the traders the ability to make nice profits, but again, it's a double-edged sword, guys. It can also, cut you and make you lose that same amount. For example, a Forex broker may offer a 50-to-1 leverage, which means that a $50 margin deposit will enable a trader to buy or sell 2,500 worth of currencies. Similarly, with 500 bucks, one could trade $25,000 worth of currencies, and so on. While this is all gravy, let's remember that leverage, again, guys, is a double-edged sword. Without proper risk management, the high degree of leverage can lead to large losses as well as gains. Forex also has deep liquidity. Because the Forex market is so enormous, it is also extremely liquid. This is an advantage because it means that under normal market conditions, even with the click of a mouse, you can instantly buy and sell at will. You're never stuck in a position. And sometimes you will find that with stocks, actually. You'll get stuck in a position because somebody may see something on this chart or with that stock, or may know something with that certain company where they don't want to do it, right? They don't want to, I guess, buy your order or sell you an order. So you get stuck in an order. You can even set your online trading platform to automatically close your positions once a desired profit level, this is called a limit order, has been reached, and you can actually or close a trade if a trade is going against you. That's called a stop loss. So those are different types of orders that we're going to go over in the future, guys. Another reason to trade Forex, again, low barrier to entry, guys. It doesn't require a lot of equity. You would think that getting started as a currency trader would cost a ton of money. The fact is, when compared to trading stocks, options, or futures, it doesn't. Online Forex brokers, again, they offer many and micro trading accounts, some with a minimum account deposit of 50 bucks. Now, we're not saying that you should open an account with the bare minimum, guys. Let's be real with it, okay? But it does make Forex trading much more accessible to the average individual who doesn't have, all the money in the world, basically. Okay, I'm going to stop right there and see if you guys have your programs actually downloaded and set up before I get into this section. Do you guys already have a practice account open and all that good stuff?
Yep.
Cool.
I do, at least. I don't know about anybody else.
Okay, cool. Well, as long as you've got all that good stuff set up, let me see.
What do you mean? I got Trader's Way, and I got.
Who doesn't have like a broker account set up or something, or at MetaTrader 4? If you don't, you can put it in the chat if you want.
Correct.
Christina doesn't. Kamaria doesn't. So there's two that don't so far.
Okay. All right. Well, hold on real quick. All right. Nope. Don't go that. Hold on. Where'd it go? Everyone.
I know that I got an account.
Okay. Let's see. Just a second, real quick.
Okay.
Right, we're going over this stuff really quickly. Let's go. No takers, no money, right?
8, 2, 1. Uh-oh.
Yo, Corey.
What's going on?
Nothing much, man. Is everybody hopping off?
No, not just yet. I'm about to show some people how to, I guess, open up an account.
Create an account. Perfect. Yeah. Okay, cool. It's still being recorded, right?
Yeah.
Okay, perfect. Thank you, bro. Appreciate it.
No doubt.
Yep.
Let me see. I want to start from like the jump.
This other webinar.
Hold on real quick.
5 damn screens on.
Let me see this real quick.
I only see 3 in there now that so far in the chat that have accounts set up.
All right, cool. Well, this is pretty much what's the end of the class, guys. Like, if you already have an account set up and stuff like that, I mean, you can probably join Ryan's session if you're in Epic. But that's pretty much all I got for you guys tonight. I'm going to help them create their accounts, and then next class is going to be Thursday, and we will, we'll set up your charts. We'll introduce you to, like, the candles, some of the charting tools and how the software works and all of this stuff. So the next class will just basically be, we'll be looking at price charts, going through the software for the most part, and getting you set up on some stuff. And then the third class is when we'll get into like the actual concepts and stuff like that. So should be pretty dope.
Yeah. So, do you have to say this, the schedule just now? I was talking more after, so I didn't hear that.
Yeah. Thursday, the next class, we're going to be going over the software and the programs that we use, MetaTrader and TradingView. I'm going to be helping people set up their charts, how I have my chart set up, so that when we dive into like the strategy and stuff like that, they can follow along. And not only that, like, they'll be able to play around with it and stuff like that, and so forth. So do
you have the whole, like, what days we're gonna be doing the class?
Yeah, we're gonna be doing class, guys, on Tuesdays and Thursdays.
Just Tuesdays and Thursdays?
Just Tuesdays and Thursdays.
Okay. So it's gonna be about 3 4 weeks.
Yeah, I would say so.
And at the same time at 8 o'clock?
Yes, sir. And then so we're going to do classes now. We'll be meeting probably 3 times in a week, but we're going to do 2 of those days as classes, and then one of those days is like a review. It gives you any kind of questions, a chance to ask any kind of questions if I need to re-go over anything and stuff like that. So that's probably going to be on Sundays, just because the market's not really open like that. So we'll just plan on meeting Sunday, Tuesdays, and Thursdays.
All right.
8 p.m. same time.
All right.
Is there an accelerated course? Mr. Derek, what you mean?
You mean he won't sit through all this?
Yeah, I mean, yeah, you don't have to you don't have to sit through all this, bro. Like I said, the first couple of classes are going to be catered towards the newbies, just trying to get them, caught up and up to date on some of the basics that we already pretty much have. So Elijah, you'll probably have access to it by tomorrow evening. Yeah, so I appreciate that, man. It's like I said, it's a lot of information, guys, that I pretty much threw up on you guys tonight, but it's good information that you really should have an understanding of if you really want to be a good trader.
Yeah, I definitely
gotta know
agree.
what you're doing. You know what I'm saying?
I highly agree. It sounds like, it's almost like normal school where you get the boring shit first.
Right, exactly.
But like Wallace was saying earlier when he was explaining this stuff to you, it's really good to know what you're doing. I mean, you always want to know the industry that you're in. So just
Right.
knowing the trade, but not knowing any of that information that was fed to you guys tonight. It's key to know that to make your whole strategy work. So
Yep.
much as some of you might not want to learn like the basic stuff like that, it doesn't really have to. Not looking at charts and stuff, it will be key when you guys just knowing all of the stuff that he went over you know, and what he's going to go over for the newbies. It's definitely good to lock all of that in your head for sure.
How like I was listening to all that, man, but ask me if you gave me a test right now, like doing like the calculations and
Oh, trust me.
leverage and all that. If I don't know exactly right now, like am I gonna even teach that down the road, right?
Yeah,
or do I
like,
need to know it?
trust me, guys. So as far as like the calculations and stuff, it's not something that you necessarily have to like remember, or manually do. The brokers do all that for you.
Yeah.
But it's good to understand that, you know, not every pip is going to be valued the same, because that's going to also affect your risk to reward ratio.
Yes. And then remember, these will be recorded too.
Right, right. And you can always
Always
come back to
go back to,
references.
like Elijah was just asking.
Mm-hmm. Exactly. So that's that. Derek, I'm not going to say there is an accelerated course, but like I said, you can skip the first couple of classes. Just come back on the 3rd, which would be, let me see, what's today? Tuesday, Thursday. So Sunday is when I will have everybody, which that's a good start date. Sunday, for like getting into the concepts and stuff. The newbies should be cool on like candles and, like I said, the software and stuff like that. Come.
What's a candle?
Dude.
So Wallace, for them to be able to download these recordings or whatever, it'll be emailed to them through the through your email system from everybody being registered. Somebody was asking how they can download it.
That's a good question. So what I'm actually going to do is I'm gonna upload these to either the website or YouTube and just have them privately listed. So that way you all can just go there and you know, rewatch them. If you want to download them, you can do it that way, I guess.
All right, Hall, does that answer your question, Hall?
Future class links will also be emailed.
Yeah, through your registration.
Correct.
Right? Yeah. Okay.
Yep. Any other question, guys? How soon we have access to recording?
Nope, I'm good.
I got a question.
What's going on?
What do I need to go by, bro? Because I know you as Wallace. So I just need to, because when I be talking to our students, you know, and telling them, I always refer to you as Wallace, but you're always as Corey up on the screen. So should I start going by Corey when I refer to you to the
Nah, man, Wallace, bro.
Okay, I just want to know, because
Wallace all the way, bro. You know what I'm
Corey,
saying?
and then I'm like, oh well, Wallace. Well, I don't know how to know.
Shoot, just Wallace, man. Whatever comes to your head. Sometimes I like to do Wallace stuff. And then maybe way off base, but what do you think of IML? I don't have any issues with IML, bro. It's pretty solid, I guess. You know, I went a different way though.
They're just different than us. They don't create necessarily independent traders. They just teach you how to trade, but their strategy is it kind of relies on their indicators and stuff. So I wouldn't bash IML. I mean, they got a good program over there. We're in a different lane. That's it.
KG said it's similar to options trading. Yeah, I mean it's the same thing, man. It's remember, options trading is just a different way to trade Forex.
Yeah.
So that's it. And then the 3 that need to set up their accounts, I'm gonna make a video for you guys, or just stay on the phone, I mean, stay on the Zoom. Let me see.
Are all of these people inside Epic, or some of them aren't, correct?
Some of them are, I believe.
Because we do have the video already made. If they are in Epic Exchange.
Oh, word.
We have, remember, inside the Exchange University Unit 2. It's all about that. It's about setting up TradingView. It's about customizing TradingView, how to set up MetaTrader 4, and I believe how to set up an account. But the account setup, the demo account, I think, is only through Trader's Way. That's the only one we have set up on there.
Oh yeah. It's pretty much similar to all of them. I mean, you just gotta set it up. I mean, I don't know. To me, it's simple,
so
but
if you guys
more language.
if you guys are in the Exchange University Elijah, I know you are. Daniel, I know you are. Paul is. If you guys are a part of the Exchange University Epic Exchange community, then you can just go to the Exchange University group page that you should already be a part of. And in Unit 2, there is a section on how to set up your trading accounts.
Yeah, so you might have saved me some work. But if you're not in there, you know, I guess shoot me a message and I'll help you. It's no biggie.
Yeah, I mean, even if I mean, we can even I can even have Caesar send you that video, bro. It's not like, I mean,
Oh, cool.
it's part of this too, so I don't want you to have to do double work. So I'll see about
Straight up.
I'll see about having Caesar get it over to you or whatever we got to do.
Okay, that's cool. That should work.
Yeah.
Let's see here. Are there any other questions? If not, guys, we're gonna cut this one short. And say have a good evening. Be ready for Thursday. Thursday, we really get into some cool concepts or some cool basics, I guess, as far as like learning the software, learning what a candle is, the different type of candles, the pips, how to count the pips, what a pip looks like on the chart, that types of stuff, right? Derek asked, what is Epic? Ooh, that's a good question, sir. Epic is
Epic Exchange.
Yeah, there we go. Epic Exchange. But no, it's a Forex MLM company, bro. It's like Brian said earlier, we're teaching people basically how to be self-sufficient versus, you know, relying on, I guess, others or product or upselling you with other products necessarily. But not to bash IML or anything like that. You know, they're doing a thing. We just, like I said, we're in a different lane. Like, we want to create self-sufficient traders. Like I said, I have a personal goal, guys, this time around to create 30 people, to help 30 people hit 6 figures from trading alone, right? Like, that's my personal goal. Like, that has nothing to do with no type of MLM. Like, that's just my personal goal. Like, I knew what I did back in the day. Like, I'm ready to boost that shit up. It's just crazy. So, hey, what's going on, Nick? You can introduce yourself, bro. Unmute yourself.
Yo, can y'all hear me?
Yes, sir.
Hey guys, how everybody doing in the chat? Well, I just wanted to introduce myself. Of course, y'all can probably see my name on the screen. It's Nick Everett. I've been trading, let me see, ever since like maybe the end of April. And I just want to let everyone in the chat, like our participants, let you know that if you want to do this Forex, it's like the market is going to tell you everything about you as a person.
Yep.
So it's going to let you know if you're too greedy. It's going to let you know if you feel like you're a gambler. It's like, man, it's going to be stressful. It's going to be times where you like going to be heartbroken. Like, oh my God, you just don't understand. And like in the chat said, I mean, in the slideshows, you cannot control the market, period. You just going to pretty much is like let the market do and, you know, just go from there. But it's all about the entry.
Yep.
And patience. You have to be patient in this market because, you know, if you can have so many trades, but if you're not in that right entry at the right time, I mean, you pretty much might as well cop that money as an L. But, you know, always be confident, do your research before you do Forex. And also, I would say all the newbies, like, start with demo. There's nothing wrong with starting with a demo because once you put that real money in your account, that's when your emotions kick in.
Yep.
Because no one likes to see their money getting taken away. No one. So start with a demo and go from there. That's all I can say because, man, demo, because that's not your real money. You're like, oh, okay, I can play around with it, but at least you can know how the market is moving and you see how much profit you would make if that was your money. So, man, just, you know, take your time, you know, do your research, learn this information because, you know, a lot of people want to, you know, they get news, like a new TV, a new game system, but don't want to read the manual. It's like you have to learn the basics first before you get into this market.
Exactly.
So, and that's just, and now I'm starting in April. And what is it? April, what, May, June,
But
July,
shit, everything
August,
you're pretty much saying, bro,
it's
really
5 months. It's like, yo, like
right.
I feel like I've been through every emotion dealing with this market, but I'm not, I see the potential that, you know, Forex has. like Forex can lead you to financial freedom. If you look into, you know, if you work in 2 jobs like I am doing right now, I'm trying to eliminate one. Having Forex, you know, build that financial freedom that I'm looking for, so I can start what I want to do, build a business, or have free time, you know, that freedom that I want to travel the world, you know, even though COVID is going on, but, you know, you still have that life that you vision yourself doing, or you see others doing, like, man, why I'm not doing that, or I may not have the money. This is an opportunity where you can, you know, get to that point where you see yourself within the next couple of years, but you have to put in the work.
Exactly.
Ain't no way around it.
Ain't no way around it. I mean, honestly, I recommend 1 to 2 hours almost on a nightly basis, at least 3 days out of the week.
Yep.
Straight up.
But I mean, that's all I wanted to say. I just want to put my 2 cents in. You know, y'all doing an
appreciate
excellent job. Definitely with the slideshows, it was very informational. It was a couple of things that I didn't know that I was taking notes on. So
that's what's
I
up.
just want to let y'all know, just keep up the good work. You're doing a very good job, you
Yeah, I
know,
appreciate it,
and
bro.
keep striving for success.
Hey, no doubt. I appreciate that, man. This is only
sure.
the beginning, bro. This course is it's pretty dope, guys. Like how I have it like laid out and stuff like that. It's pretty dope. Like it's gonna, like I said, it gets deep in some areas, right? So
Yeah.
you guys are going to like get like a very informative and educational thing with this. Like this isn't something that, you know, I just haphazardly threw together. Like it's structured in a certain way. So, but yeah, man, I appreciate your input though, bro. Like that's you, everything you said was spot on pretty much. Like, you know, it's going to teach you a lot about yourself. And like I said, I've been open with this since day one. Keep it 100, guys. Like when I first started doing this shit, like, yo, I was nowhere near on the level that I am now. But when I first started, like back in 2014, 2015 and shit, like I lost a shit ton of money, guys. I'm talking about a shit ton, from broker accounts being shut down to losing out on a fucking hotel that I had a contract with, to you name it, man. So like that put me in a nice depression, guys, for like 2 years. Like, yo, I almost committed suicide because my mental wasn't right. My year anniversary is actually this December coming up, if that gives you guys any kind of insight. So please, please, please understand, emotionally and mentally, you have to be in it. You have to be focused. You have to be clear-minded, right? That's why I said, if you broke up with your girl, don't even trade, bro.
Yeah.
It's not worth it. So,
Got to keep emotions out of it.
exactly.
And what you guys need to remember too is, think about this. What we're teaching you here is a skill set that you can make way more money than a doctor. I mean, you literally can, like literally can make way more money than that. And think about how much they dedicate when it comes to learning, and how much they sacrifice for 8 to 10 years out of their life, like every single day. So think of it that way. I mean, this is an opportunity and a skill set that Corey's taking the opportunity out to, you know, to feed you guys. And I mean, you literally can, if you focus for 6 months, you literally can pick up this skill set and make more money than a doctor. So think of it that way. I mean, you don't have to put 8 to 10 years, but if you just cram your dedication into what Corey's feeding you, what we are at the Exchange feeding you. If you're in Epic, what Epic's feeding you, just remember that, like, you're spending a fraction of the money. Well, actually, if you're just doing it from here, you're getting it for free. So, but you know, I mean, even if you are paying a little bit of money, you're paying a fraction of money, and in a fraction of the time that a lot of these other career choices you have to spend years in. So just remember that. Be thankful that, hey, yeah, you might have to stay dedicated for like 6 months, but you literally can be an independent trader in 6 months if you really stick to it and keep your mentals and your emotions in it, for sure, like Corey was just saying.
Yes, indeed. So, Christina and the other 2 people who need to be set up, I'm going to send you all this video, so that saves me some work. And then
Yeah,
if
KG,
you have any questions,
really quick, Wallace. KG,
yeah.
yes, it is in University Exchange University Unit 2. Unit 2, it should have, I think, 4 videos. of how to set up. So, and then Wallace, I think he was just about to say is he's going to send the video out to you guys too. So.
Yeah. So, and then if you guys have any questions, anything like that, feel free to just hit me up and I'll help you guys out.
Actually, one question real quick.
Yes, sir.
So when I first started with Brian and C's, they always saying buy and sell. And you started saying long, bid, and buy, like long and bid. Is that the same thing? All the same word for
Yeah,
buy,
so
long and bid? And
when somebody
short, ask
says,
and sell?
So here's the difference. So you've got the bid is what you are, let me start over. So going long is when you buy.
Mm-hmm.
Going short is when you sell.
Right.
All right. So that's talking about what type of order you're going to enter. All right. Now, when it comes to like the bid and ask, that's talking about which side you're on and the price of what you're selling something at. So when you're bidding on something, you're putting a bid in at a certain price, right? It's like kind of like an auction. If you're sitting in the crowd, you're a bidder, right? That's what you want to buy that for.
Okay.
But if you're on the other side of the equation, if you're in an auction, you're the seller, you place your item up for an asking price, right?
Yeah.
That's what you're selling it for. So the ask price is what you sell for. The bid price is what you buy for. So you bid, you go long and you buy, you ask, you short, or you sell.
All right. That's why I have it written down. I was making sure I had it right because they didn't use those words.
Are up and down. Ones go up, ones go down, but it's the way he just said it. Just terminology for going long or buying or selling, kind of. But to ask, yeah. So that was a good question.
All right. I just different terminology that I had learned. I mean, I didn't that long, but just different terminology. I just want to make sure I got it right when you say something. I'm not like questioning myself or what you're saying. You know what I'm saying?
Oh yeah, no doubt.
All right, that's what's up.
All right. Any more questions, guys?
Good.
Yeah, Derek, that's a little bit backwards. You bid, you
Is
buy,
it?
ask, you sell.
Is there anything we should do until what was it say, Tuesday, Thursday? Anything we should be reading over, looking over videos?
Shoot, I'm gonna release this probably tomorrow. You guys can review this and then just be ready for Thursday, man. Like Thursday is when we start getting to some little bit more funner stuff. Now that we got some of the boring shit out the way, we can go through the price charts in the software. You know, so
yes.
All right.
Hey, that's about it, guys. That's all I got for you all tonight, now, man. What is it? Tuesday?
Appreciate it, man.
No problem. I'm actually going to take a break and then I'll probably hop on the charts in like an hour or so. But let's see here.
Yeah.